Welcome back. You're still watching Crystal Ball. I have been in conversation with Ridham Desai of Morgan Stanley. From an asset class point of view, it is obviously good news for stocks that real estate is not doing well and gold is not doing well. But with the way real estate is shaping up across the country, do you think it has the potential of creating a lot of stresses in the system because it's an asset class which is almost it's almost beginning to come apart? What ramifications could it have on general economic growth and general public sentiment?
So then let's first understand why this could be happening. So if you go back, say, to 2009, when India made specific policy choices with respect to its fisc and monetary situation, it decided to run both a loose fiscal as well as a loose monetary policy. The consequence of that was that real rates fell in India. Eventually, we got higher inflation and real rates turned negative. The response domestic households gave was they shifted their saving from financial assets to real assets. So there was a marked increase in saving into property and gold. We reckon that there was almost a 500 basis point shift away from financial asset to household property as well as gold. We think that has ended about a year ago. And now a reversal is in place where households are pulling money back into financial assets away from property and gold. It's a reflection of positive real rates coming out of good monetary policy action as well as fiscal consolidation. So that's the macro backdrop which is leading this. Obviously, nominal flows are still good because household saving in India are arguably growing in double digit. But the share of property and gold, I reckon, is likely to fall and probably revert to where it used to be 5 or 7 years ago when the split between financial and real assets used to be even. Today it's about 1/3, 2/3. So financial assets are about 1/3 of total household savings. So we are looking at a big shift in favor of financial assets. And that could have implications on how property prices may behave versus how they behaved, say, over the last 7-8 years. With respect to your second point, which is the systemic risk that it creates, I don't think that's something to be too worried about because the loan-to-value ratios in India actually are quite comfortable for banks. And if there is one sector where I think there is a less likelihood of stress, I think it's in the household property sector. There may be some issues in, say, commercial property, but I think those will be scattered and not comparable to the size of the problem that we saw, say, in infrastructure. The key thing is whether the infrastructure bit gets resolved and whether the bad assets there actually start declining. I think that will be good enough to take care of any losses that may emerge in the property sector. But I think given the loan-to-value ratios, I think we're okay with property for now.
You've led me into my next question, which was what kind of stress are you expecting from the infrastructure sector? Because last week, this whole CARE downgrade of JP Associates loans or debt did roil market sentiment, particularly for banks like ICICI Bank, which has a 5,000 crore exposure to JP Associates. How much is left from this bad asset quality point of view, which is still something which the market cannot see or fathom today? Do you think it can still get worse? Because we were beginning to think we were almost at the end of the NPS cycle and things will slowly start to improve, and then we are getting hit with these 60,000-70,000 crore monsters.
So then I think there are several parts to this story. First is what's happening to the broad corporate sector. Over there, I think there has been distinct improvement in credit quality. And the best ratio for people to track is the credit rating upgrade to downgrade ratio that's published by rating agencies. That number is actually at a 6-year high. So it suggests that there has been significant improvement in the broad market credit quality. In fact, that number is running at around 2, which means credit upgrades are outstripping downgrades by a factor of 2. Now, that said, there is still a problem with, say, the top 50-60 loans that the banking sector may have. And there could be issues that may arise over there. So while bad loan formation may have peaked, recognition of that may not have peaked. So there may still be an accounting issue for banks and they may still have to recognize bad loans. I think bulk of the problem lies with the state-owned banks, which is why we continue to have a cautious view on them. we think they still have some room to recognize, and since their capital adequacy ratios are running low, they may continue to lose market share as we have seen in recent quarters. So the answer to your question is, I think the worst is behind us, but it's going to be a slow recovery. And the key is, how quickly growth recovers for the country as a whole. And that, I think, will decide how much pain is left in the bag. But we do think that, investors to still be careful about SOE banks because of this.
Just SOE banks, or maybe even some private sector banks, given the recent episode? Do you think there could be pain for some private sector banks as well?
Selectively, yes, but I think generally speaking, private sector banks seem to be over the hump on this. So selectively there could be problems, but I think generally speaking, if I were to break it up into two baskets, then I think SOE banks have more pain. You will probably find that on the aggregate, private sector banks will report lower non-performing loan formation.
What's your general take on earnings, Ridham? Because we've gone through about a third of this earnings season as well, and it's shaping up like another quarter which is not going to be great. So there have been more disappointments than positive surprises, Infosys excluded. How many more quarters of this kind of lackluster earnings do we need to go through?
So then I think we need to break earnings up into two parts. I think there's a distinct improvement happening in one part, and the other part is struggling. So the part that is struggling essentially consists of global commodities, global energy, the state-owned banks, and to some extent, companies that depend on exports as their key driver or global operations as their key driver to earnings. So those are the four parts that are struggling. The stuff that is doing well are essentially all the domestic sectors like consumer discretionary, consumer staples, industrials, the private sector banks, even utilities and telecoms. So there I think the earnings growth actually is likely to be quite strong compared to recent quarters. The global bit will drag down the headline. So I think the headline number for this quarter may continue to look poor, slightly better than the last quarter, but still bad. But if you break it up into these two components, you may find that the component that I called as domestic sectors, which consist of a large number of sectors, may actually end up reporting double-digit growth this quarter, which may be the best that we've seen in a while. But the global sectors, or the sectors that depend on, or the companies that depend on global operations to drive their earnings, may actually report pretty feeble earnings. And this is essentially goes back to the point that you asked me earlier, which is where is the problem for this market? Is it in homegrown issues, or is it global? And I think it is still global. And that's where I think you'll see also reflected in earnings, and you'll probably also see it reflected in share prices. Though the last bit, I think, all depends on what's priced in. So at some point in time, global sectors may have priced in so much of pessimism that even though the earnings are weak, they may actually become good sectors to buy. I don't think we've reached there, but that may happen. So it's not necessary that bad earnings means bad stock prices after a certain point in time. But I think that's what's probably happening this quarter. I think next quarter this gap may actually widen, which is domestic sectors may actually accelerate in terms of performance, and global sectors may continue to struggle. And maybe this is the story for the next couple of quarters. We think that domestic sectors may actually accelerate growth towards the 20s by the end of this financial year. And depending on what happens to the global bit, the headline number will be so determined. But I still think we are probably heading for a mid-double-digit growth for the market as an aggregate by the end of this fiscal. So I remain constructive on earnings. I think there is a fair bit of macro healing that has happened in India. Capex is up, and it's up a lot. The inflation problem has been resolved to a great extent. We think interest rates will decline. We're already seeing market interest rates actually at 5-year lows. The policy rates will follow suit. And that, I think, sets us up for a much better second half of this fiscal year in terms of earnings.
Running out of time, so I'll end with one last question, which I usually refrain from asking you since you're not a chartist. But do you think any rough patch or any glitch which may come about for whatever reason will still not take the market meaningfully below this floor of 8,000 where we've been bouncing back from the last couple of times we've been there? Is that the floor?
I don't know the answer, Udayan. How I wish I knew that answer. 8,000 seemed to be a very strong level, but markets are markets, and trying to predict them is the best way to go wrong on them. What I can say, of course, is that as and when this market corrects because of a rough patch of rough news which comes through, I think investors should focus on the long-term story, which in my view remains strong. And as we've seen over the past several months, these corrections have been good opportunities to buy. Every correction tests your conviction. It makes it appear as though this correction is going to last longer, and then it doesn't. And I think that that template should be continued to be followed by investors, and I think the results should be quite good in the end.
On that note, I'll thank you. It's a pleasure talking to you, Ridham, as always. Thank you very much for your time today.
Thank you, Udayan.